All right, good Thursday afternoon. And if it's Thursday afternoon, it's Finom Group's weekly State of the Market with me, Seth Golden. And wow, August went out with a bang, and here we are, September. Probably going to reiterate a lot of the things that we've talked about in the past because a lot of the themes that we've discussed in the past remain true. Firstly, foremost, when's the next significant pullback going to take place? Nobody knows, but we have a lot of data that might lend itself to a better understanding the probabilities for the market and any type of corrective behavior, if you will, going forward. All right, so with that being said, S&P 500, weekly state of the market, 7-month win streak for stocks has to end. Question mark. And it may, right? This is the worst month of the year, going all the way back to 1950, right? September, I mean, most people have heard that, understand it, accept it. In that sense, have low expectations. Don't have these lofty expectations set on the market when historically it's not all that great for the S&P 500. With that being said, today, Thursday, coming into today, the S&P 500 had 53 new all-time highs as of yesterday's close, but make that 54 as of today. The S&P 500 hitting 45, I believe. 45. Don't get no better than that, right? This market seems to have a rhythm to it. So with that, also in the month of August, 12 new all-time highs for the S&P 500. That proved the most in August ever and most for any month since 14 all-time highs in January of 2018. No, early February 18, we did have, we hit the peak in the market, then we had a 12% correction. The all-time record for new highs in a single month was 16 in June of 1955. So with August behind us, we now know that we have a 7-month win streak, right? Ever since February and through August, we now have a 7-month win streak. As shown in the study above, which we've looked at in the past, the 1-month average return is a measly 0.9%, but the 63% probability told us we should expect for August to deliver a positive return. What about September? Well, September's not much. It's a 63% probability, 2 months out. And the return's a little bit better at 1.28%. So 7-month win streak, the probabilities do favor. They're better than 50-50 that we're going to have another positive month here. There's a lot more, than just a 7-month win streak and the probabilities for an 8-month win streak. What does August say about September historically? We'll get into all of that. So again, September can be trouble. You don't see any, positive candles here, right? Whether it's from 1950, down. Past 20 years, down worse. Past 10 years, not as bad, but worse than going back to 1950. What about post-election years? It's a little bit better, but there's no green. There's no positive candles here. They're all negative. So let's dig a little deeper to see if, that's all there is to assess the probabilities for a positive market return in the month of September. Since 1928, September is the only month to show more down months than up. 50 down months versus 42 up months, going all the way back to 1928. Although this bull market has laughed at nearly all the worry signs in 2021, let's not forget that September is historically the worst month of the year for stocks, says Ryan Dietrich of LPL Financial. Even last year, because we can't forget last year, right? People always say, well, we haven't had a 10% correction. Yes, we have. From September to the trough in September, it was a 10.8% correction. The problem was it didn't stay down 10% intraday. So we didn't have a closing basis 10% correction. Why do we need it on a closing basis? We don't. And that might be what trips up a lot of investors and traders, analysts and strategists who keep calling for these corrections because we haven't had one 10% or greater, in the last year. But the reality is we have. You wonder why you're getting tripped up and why the trend is so strong. We've corrected. We have. Just because it wasn't on a closing basis, why does that have to be the qualifier? Anyways, the S&P fell 9.6% from 9/2, so September 2nd of 2020 to September 23rd of 2020. We lost 9.6%. Again, on an intraday basis, we were down 10.8%. It's a pretty nice intraday reversal to only finish down 9.6%. Notice though, we don't see 2020 in the study of the 6-month win streaks, right? Here's the 6-month win streaks. 2020 is not in there, folks. Again, remember that streak started in April. So that's a differentiator here from last year. If we're looking at, well, September last year sucked for the market, right? Why not this year? It had a great streak last year going into September. Why not correct this year when we have a great streak going? Well, a differentiator is we did not have a 6-month win streak going into September. And this year we have a 7-month win streak. The market is that much stronger, has had that much more of a long-term uptrend. All right, here's what else, okay? September. Okay, so far, none of the data suggests we should be up in September, right? But what you do in the first half of the year tends to find the same type of trend in the back half of the year, okay? So in the first half of the year, we had a positive return. In fact, this study here from Fundstrat, in the first half of the year, let me see if I can, okay, there we go. X recessions, so we're not in a recession, we're in an expansion cycle. In the first half of the year, if the returns are greater than 13%, look at September. Look at September, folks. And by the way, this goes all the way back to 1928. I'm not cherry picking since the 90s or the 80s. This goes all the way back to 1928. If the first half of the year was greater than 13% return, September delivers a positive return of 1.4%. What's the win ratio? 67%. It's even better than our 6-month, 7-month win streak study, right? Now, of course, all years tend to deliver, right? All years, going back to 1928, tends to be a slightly negative return. And the win percentage is only 46%, right? Most of the time, going back to 1928, the market is down. Again, though, when you have a greater than 13% first half of the year, and we had a 17% return the first half of this year, the market continues to rally. Momentum begets momentum. 67% win possibility for the month of September. Just saying, folks. And as I said before, for those who keep calling for a correction, the market has already corrected. I mean, the S&P 500 index, compared to 52-week highs, the average decline has already been 9.1% for the average stock in the S&P 500. The average stock has already declined 9.1%. Underneath the surface, we have corrected. What else is different from September 2021, September 2020? Last year, here's the percent of stocks above their 50-day moving average, right? I mean, last year, we had 80% of stocks trading above their 50-day moving average. That's what happens in a newer bull market. In a newer bull market, you have that really strong breadth before you get some kind of corrective activity in the month of September. Like, we've already gone through that. This is not an early cycle bull market. This is like a transitioning to mid-cycle bull market where we've already had that strong breath. We've already had corrective waves. And now it's about leadership. It's about leadership. Most stocks have already corrected. We have a different breath structure today than we did back then. Why? Because we've already corrected. We've already gone through those undulations in the market. This was a newer bull. Look at how extreme this breath was in the early stages of the new cyclical bull market, May to June. We had more than 90% of stocks above their 50-day moving average. Had a corrective wave here in June into July. We still had 80% of stocks. It was still new. It was still fresh. We had a lot of leadership. Everything started rallying. That's not the picture we have here today, folks. Another way that we can look at the differences between 2020 going into September and 2021, now that we're in September. The value line geometric basically gives you like the average, the equal weight S&P 500 in a sense. So the XVG, the value line geometric index, is an equally weighted index using a geometric average. The daily price change of the value line geometric composite index is found by multiplying the ratio of each stock's closing price to its previous closing price and raising that result to the reciprocal of the total number of stocks. It's an equal weighted index. Well, look at here, folks. I mean, you had a significant rally. Here we are going into September. Now, what I want to identify here is that we had not yet made a new high in the value line geometric index. We had not yet made a new high. But the S&P 500 had already achieved a new all-time high. So there weren't necessarily as many stocks trading closer to the breadth was a weaker. Although we had, a significant number trading above their 50-day moving average, that was more a reflection of the fact that the 50-day moving average had plummeted so quickly during that 17-day fastest bear market in history. What this equal weighted index tells us is that breadth, the strength of the market, the overall market really wasn't as strong as the S&P 500. It was prone. It was vulnerable. Is it as vulnerable today? Heck no. This is the equal weight of the market. And by the way, the equal weight S&P 500, ticker symbol RSP, has also made a new all-time high within the last 3 trading days. So again, this looks very different than this here. This is not as vulnerable as this here in terms of corrections, in terms of, massive drawdowns, if you will. It's a very different state of the market. This is looking at the longer term breadth as well, right? We looked at the 50-day, the stocks trading above the 50-day moving average and the difference then versus now going into September. Here we're going to look at the longer term breadth using the 200-day moving average. Stocks trading above their 200-day moving average in the S&P 500. Going into September here, again, the trend was strengthening. The trend was strengthening, but only, less than 60% of stocks were trading above their long-term breadth moving average. Now, we got all the way up. I mean, earlier this year, we had over 95% of stocks trading above their 200-day moving average. We're normalizing here, but we still have almost 80% of stocks trading above their long-term moving average. So again, we're looking at a trend that has been solidified and is stronger according to the long-term trend than it was going into September of 2020. Again, we're talking about September here and vulnerabilities. Is the market more vulnerable to a similar correction that it had in 2020, September 2020, is today. So far, the breadth metrics, the value line geometric index suggests we have a stronger long-term trend and a stronger overall market than we did last year, this same time. All right, 7-month S&P 500 index win streaks or greater, right? 7 months, August. When we have, a 7-month win streak or greater, unfortunately, none of these have August, by the way. None of them. But, some of them had to have had a 6-month win streak because here's September here and here's a September there. So when you have at least a 7-month or a long win streak, if you will, if we look at the 1 month going forward, and again, this just about matches what we saw in the initial study, the next month or month 8 for us this time, the average gain 1.2%, the exact same as we saw in the prior study. 3 months out, right? So forget about just 1 month later, which would be here in September. About 3 months later, the win percentage is 85%. 6 months later, 12 months later. Like you gotta love these win percent rates. Right? S&P 500 being positive 85% of the time, 3 months later. 93% of the time, 6 months later, after strong win streaks. I feel like a broken record. I mean, I'm sure you guys are to some degree tired of hearing this, but as we advance, right? The cries for a correction get louder, the drum beats for a correction, and the wall of worry builds that much more in the financial and social media networks. So we're reinforcing with new studies and revisiting old studies to see if anything has changed. Should we expect something different? I mean, August is not September. September is not October. So we need to have a running relationship, a running dialogue with, the data, the quantitative data, as we progress through this, this win streak and into the end of the year. So looks good. Long win streaks do not suggest we should anticipate a major correction. History does not always repeat, and this is not to predict the future, but when it comes to the probabilities, we want to be able to lean into the probabilities as a discipline. All right, we talked about the sell side indicator from Bank of America in the past. So guess what came out today, folks, right? Remember this one from, this was May, June. So that's July, right? The sell indicator being at its highest level. Here we were again. I mean, that was prior to this more recent signal in February. We were getting that much closer. This was just about touched. Well, here's the latest, right? From just basically 2 weeks ago. And we're still, we're basically touching the sell signal. So all year long, Bank of America has been heralding, their extreme bullishness, which means bearish for stocks. It's a contrarian indicator, sell signal. Basically all year long since February. These are not indicators, folks. It doesn't mean we can't roll over tomorrow and have a correction, but using these for timing tools, it's just a bad discipline. And Morgan Stanley out this week again. Morgan Stanley with the S&P 500 up more than 20% year to date. Alpha has been harder to generate this year. I don't disagree. The S&P 500 seems like it went from 4,000 to 4,500 in just a couple months, right? The opportunities become fewer and far between. In this market of constant rotations, though, you simply have to be nimble. You have had to ride this trend, for its duration in order to, be advantaged by the uptrend, continue to, produce those capital gains, lock in profits if you reach your targets. It's the ones that have been sitting on the sidelines that haven't engaged these rallies because of Morgan Stanley's constant drumbeat for a 10 to 15% correction pretty much since May of last year. And I'm not being facetious. I'm not being hyperbolic. They have literally been calling for a 10% correction since May of last year, right? Because remember, we had a 10% plus rally in April off of the March lows. It's easy to, fashion this, well, we got to check back. We ran too hot in the month of April, so maybe we'll give some back in May. We never did. We just kept going up until June, July, August, finally had a correction in September, but they just kept beating that drum. All right, market performance before Labor Day, right? Next week is the Labor Day week. Next week is Labor Day trading week. I'm emphasizing that because we are pre-Labor Day. This is how the market performs the individual indices before Labor Day. This is Thursday, the Thursday before Labor Day that we're recording, S&P 500, and this harkens back to 2020. Thursday of last year, pre-Labor Day week. That was the start of the correction, the 10+% drawdown intraday, not on a closing basis. We were down 3.5% that day in 2020, September 2nd last year. I think it might have been separate. We're a day behind last year, possibly. So Thursday of last year. Look at the NASDAQ, folks. We were down almost 5% in the NASDAQ that day. Look at tomorrow. All right, but here's the average going all the way back to 2000. So going all the way back to 2000, Thursday, flat for the S&P, pretty flat for the NASDAQ, pretty flat for the Russell and the Dow. What about Friday? Going back to 2000, the day before the Labor Day weekend, nothing burger, nothing burger, nothing burger. There's no edge here, really. No edge. What draws this, back more to the flat line was 2020. Just a big down day here, followed by another. This got piled on as the correction started last year before Labor Day. All right, so in the last 21 years, Thursday has been the weakest on average. Stocks sold off strong with the Dow off 800 points on the Thursday before Labor Day. Just a heads up, the S&P 500 had a 10-day win streak heading into that Thursday decline ahead of, we were up 10 days in a row leading up to this, this Thursday massacre of sorts, 10 days in a row. The frequency of gains have been modestly better on Friday, as you see. In harkening back to see, that's the thing that you kind of got to be aware of, that 10-day win streak that led to this big give back here in 2020. Why? Because we are coming off of some just awesome streaks, right? We've had 2 5-day winning streaks in August. We had a 7-day winning streak, at the end of July into August. There's been very few down days here over the last month or so, folks. That, in a sense, does mirror what we saw last year around this time frame. And as we pointed out with this chart in the past, 5-day win streaks, we have often given back the gains. And this is going back to last year, 5-day win streak, 10-day win streak, big move down. Here in 2021, 5-day win streak, move down, 5-day win streak, move down, 5-day win streak, roll over, 5-day win streak, move down. We had a 5-day win streak just recently. We haven't given back the gains. We have continued to rally and make new highs here. Momentum begets momentum. But at these levels, I would also emphasize, price becomes very sensitive. The higher we go without some degree of give back, price becomes more sensitive to headlines, even if they seem innocuous. All it takes is some kind of piece of economic data, to fire off, an algorithm that sends the market lower. Not to spook anybody, because we do have the non-farm payroll report due out on Friday. We know that has spooked folks in the past, hearkening back to February of 2018. That day that the non-farm payroll came out, it did spook the market after a severe uptrend from late 2016 through all of January 2018 without a 3% drawdown. Forget 5%. We didn't have a 3% drawdown back then. The non-farm payroll report came out, and all of a sudden, we were in the midst of a 12% correction into April. So from February to April, 12% correction. If you're bullish, you actually are hoping to see a near-term healthy pullback for the market. The conditions have to be there. That's all. The conditions have to be there. If the conditions aren't there, you need to rely on something else. What is that something else? A catalyst, like a piece of economic news, economic data. All right, with that being said, we haven't had a 5% drawdown on a closing basis this year. In the past, we looked at the S&P 500, a study from Bank of America that showed if the S&P 500 doesn't close below its 200-day moving average through the first half of the year, what to expect in the Q3 and Q4 so far as returns and the biggest drawdowns on average. Well, this particular study, when the S&P 500 does not have a 5% correction year to date through August, I mean, it doesn't get any more up to date than that. Through August, September, 4Q, and September through December are up 100% of the time with stronger average and median returns when compared to all years going all the way back to 1928. So if the S&P 500 does not have a 5% correction year to date through August, returns year to date through August average 15%. Set the September return, look at that. Now here's your problem. Percent of the time the market is up, only 50% of the time in September, right? Only 50%. We have not had a 5% correction on a closing basis right there. But the market in September is only up 50% of the time. However, the average return is still 1.4%. So what's it going to be? We'll see. The Q4 return, given this criterion that we've already recognized, the Q4 return, percent of the time up, 100% of the time. So maybe we're going to get this 4% correction here in September. Maybe, right? It's a probability. But the Q4 return is higher 100% of the time, again, going back to 1928, if we have not had a 5% pullback on a closing basis through August. You want to buy this dip. Oh, I know they haven't passed the infrastructure bill. I know the Delta variant. I know the University of Michigan sentiment just dropped to the lowest level since 2011. I know the Fed may be tapering or announced their tapering in September, which I still am doubtful, especially if we do get a bad non-farm payroll report tomorrow. Like, I know all these variables. You don't think there were worrisome variables in all of these years? You don't think the circumstances were different in each of these years? The circumstances are always different. What this data tells us is that no matter the differences of all these years, human behavior was so consistent, it's ridiculous. Buy ... You know what to do. All right. September to December returns, 100% positive, but of course, right? The annual return, very strong, 24% on average. We're up 20% going into September, a little bit above 20% going into September. What's the max drawdown from September through December, given this criterion? 4.2%. The average draw, the median drawdown is only 3.9%. Are we good? We good here, folks? All right, let's move on. I had mentioned you need the right conditions, right? So either you have the right conditions for a bigger pullback or you need a catalyst. We can talk and discuss till we're blue in the face what the catalyst might be. Usually we don't know what the catalyst is. It is something that just, happens. It's a headline. It is a piece of economic data. We don't know it ahead of time. It's often why you get a bigger drawdown, because it's something that people weren't expecting. So if it's not a catalyst, you need the right conditions. This chart right here from Liz Ann Saunders, actually, the S&P 500 top 5 stocks, right? Think FANG. The top 5 S&P 500, top 5 S&P 500 X FANMAG, which is Microsoft. You're including Microsoft and you're taking out Netflix. The blue line here is last year going into September. Look at the spread between X FANMAG and S&P 500 top 5 this year. Get it? The conditions were right last year. The S&P 500 top 5 stocks relative to the S&P 500, the bottom 495 stocks, okay? That's the blue line. The relative outperformance of the top 5 versus everything else. And look at it today. This is 2021. This was 2020 going into September. This is 2021 going into September. Things are a lot more even this year. See, last year, you could have sold off FANMAG, right? Because the outperformance was so heavy. In a cap-weighted index, what's going to move the index? It's going, you sell those names, the market's going down. Even if, other areas of the market do better, small caps come on board, mid caps come, cyclicals come on board. If all of the FANMAG are going to go through a correction, the index is going to correct. The conditions were right last year based on the fact that FANMAG had such material outperformance from the March bottom through August. It had extrapolated all the yield. Investors were looking for yield. They were looking for safety. What better place to get it than in those FANMAG names, which is why it had such relative outperformance versus the 495 stocks below. That's not the case this year, as shown by the 2021 relative performance ratio. So the conditions were ripe last year. It's not the same conditions here this year. It would be harder to get FANMAG to sell off to the same degree it did last year. It doesn't have the same outperformance. Look at Apple. Apple's done well lately, don't get me wrong. Look at Amazon. Amazon's done nothing. Both of them are actually lagging the S&P 500. The conditions just aren't the same. Anything could spark, the market and the FANMAG names to correct, but it's not going to be these conditions. It would take a catalyst, in my opinion. All right. S&P 500 is, as I mentioned before, we're up about 20% year to date at the end of August. How many times has that happened in history? Not too many. 1, 2, 3, 4, 5, 6, 7, 8 times. 8 times. Here we are, 2021. What happens the rest of the year? Look at these returns. The only negative one was 1987. Look at that return by the end of August in 1987. It's not double, but it's like 3/4 more than what we've done here this year. Then I get it. That was wild and woolly in 1987. This isn't as wild and woolly as the media would fashion their narratives to have us believe. It's like 90+% win rate the rest of the year, up 20+% at the end of August. Don't be scared. All right. S&P 500, the last 20 years, Labor Day week. Labor Day is next week, right? We're dealing with the pre-Labor Day trading data. Now we're going to look at, or we've dealt with the pre-trading day, pre-Labor Day trading days data. Now we're going to look at the Labor Day week itself for the S&P 500 over the last 20 years. Over the past 20 years, the S&P 500 has averaged a 0.27% loss during the 4-day Labor Day week, because Monday is going to be closed. Half of these returns have been positive, even over the past, and there you go, percent positive just half of the time, and we average a loss. A positive return, though, for the S&P 500 heading into Labor Day. Remember, momentum begets momentum. A positive return for the S&P 500 heading into the holiday week has been a good omen for stocks. And the index is up big on the year already. When stocks have been positive heading into Labor Day, the S&P 500 has averaged a return between 3.5% and 4% the rest of the year. So maybe it's going to suck next week. But above 10% return, the rest of the year should be pretty darn good, folks. You want to stay invested. Bottom line, stay invested. We're in a bull market. We may get a hiccup. We may get a catalyst. I don't know, nor do you. That's the beauty of the market. Nobody does. I love all these folks. They told us, right? They told us that we were going to get an infrastructure bill by X date. They told us we'd have a 10% correction pretty much ever since February. They told us we would have, a 5% correction here and there. They tell us, they know the Fed is going to taper, sooner rather than later. And then we get Jackson Hole, which proved to be a nothing burger. And by the way, they're as a data dependent today as they were, the last 4 years. Everybody seems to know what's going to happen. When you ask them what they're having for lunch, I don't know. And that's just it's the market, folks. Everybody swears up and down they know what's going to happen next, and yet they don't even know what they're going to have for lunch that day. Stay invested. Don't be scared by the stuff that you see on Twitter, or the folks that constantly beat their drum on CNBC and Bloomberg, calling for a 10% correction, offering you the rationale as to why we're going to have one. And it all sounds smart. It sounds plausible. This market has defied all of that because human behavior, because earnings, because above average economic growth, no matter what you've thrown at it so far as your rationale, this market has followed the trajectory of earnings revisions to the upside. It has not dipped below a 20 forward PE multiple all this year. Keep that in mind. Stay invested. Bull market cycles, since 1942, bull markets have averaged 60 months. They've averaged, which is 4 times longer than bear markets. They're about 16 months. So 60 versus 16. There's no better argument for staying invested long-term than this chart and that data. Where do you want to invest if, we correct? We talked about this during our weekly research report. In terms of seasonal patterns, and don't go purely by seasonal. You have to have a touch point with what's going on in the market, what's going on in the macro market cycle, because seasonality by itself doesn't always play out. We've also talked about that before. We had no, April showers. We had no June swoon. We did have a July into August surge. We're supposed to have an August drop-off, though, in the back half of the month. That just didn't materialize either. So seasonality is not always perfect. which tells you got to have those touch points with your market today. Know the data. Don't be afraid of the data. Here, the Russell 2000 or small caps tend to have a nice surge into September, mid-September, and then they roll over. By the way, what's been leading here this week? Small caps. They have gotten a material surge back above their 50-day moving average. Think about small caps, though. They have not broken out. They're the one indice that the Russell has not made a new all-time high, basically since June. So keep that in mind. The rolling 6-month total return spread between small caps and large caps, it's the greatest we've seen since 2000. If there's any, due leadership switch or, handing off the baton of leadership, this suggests that we should be open to the probability that that leadership has, started to shift in favor of small caps. Another, data, when you think of the Russell 2000, you have to know its composition. The Russell 2000's composition is first, the healthcare is the number one weighting in the Russell, followed by financials. So you need financials to work. If the Russell's going to work, if this, is going to reverse in favor of small caps over large caps, and that might be happening. Liz Ann Saunders noted that the percentage of financial stocks trading above their 50-day moving average has gone from a low level to a very high one. Low to very high. The percent of stocks in the financial sector ETF, the ticker symbol is XLF, has gone from this low level to all the way up here. More than 80% of stocks are trading above their 50-day moving average in the financial sector ETF. Within 30 days, the sector cycled from having fewer than 20% to more than 95%. In the past 5 years, you're looking for a trade idea? In the past 5 years, the only times this has triggered were February 2019 and May of 2020 last year. Both of those signals led to double-digit gains. Whenever medium-term participation in financial cycles from a low to a very high level in a relatively short number of days, the sector has tended to keep going. There's been 42 such signals over the past 70 years. Only 3 of the 42 led to any meaningful losses over the next year. If you're looking for an idea, folks, this may be it. Small caps, financials, the two kind of go hand in hand, given the cap weighting of financials within the small caps. Another tweet from Liz Ann, looking at active flows active flows are going down, active equity flows into active, fund managers versus passive flows. Both have basically gone down in 2021. But man, people have stayed away from active fund managers. Active portfolio managers has a greater probability of overreacting to price trend and a disruption of that trend than does a passive portfolio. Passive portfolios are, largely set it and forget it. The emotional quotient is ever present with an active portfolio manager. Let's be honest with ourselves. That's what we do. If you're watching this video, you're more than likely, a Finom group member, and you're actively managing your portfolio. Maybe you're one of our YouTube followers and you're actively managing your portfolio. The headline breaks, the price action goes against you. It's hard to disassociate the price and your emotions. Autopilot programs or game plans often prove the greater advantage to the average investor. You got to have a game plan, folks. The game plan, set it in motion. When price gets weak, you'll know what to do. You won't be reacting based on what's up here, but rather what you understand from your game plan. It's when you don't have a game plan, and broken record, I've said this time and time again, when you don't have a game plan, you're out there floundering. Should I, shouldn't I? And when you're debating that with yourself, more often than not, you're going to make a bad decision. Have a game plan and execute it. We've often discussed the emotional quotient over the intelligent quotient, or IQ, EQ over IQ. We are almost preconditioned to overthink things, and especially when it comes to money matters, right? This is pretty cool here. What's great about this list here is that 3 of the 4 tips to better investment performance involve psychology. Mind over matter. Keep things simple and stick with plain vanilla, broadly diversified funds. You've heard me say this time and time again. You can make investing as complicated or as simple as you want to make it. The more simple you make it, the less taxing it'll be on your emotional quotient. Automate the routine. Have a game plan. Have a game plan. Automate the routine tasks such as setting asset allocation targets and periodically rebalancing. These are things we talk about almost daily in the trading room, Finom Group trading room with members. Number 4, embrace techniques that put investment decisions, again, on autopilot, such as dollar cost averaging. Know where to, if the price gets weak or if you get a better value than where you started that investment, you should have a game plan where to add when price gets lower. You should have a game plan where to lock in profits when you achieve target levels. It's not about should I, shouldn't I. The game plan is there. The routine is there. It's tactical. All right. This tweet from Larry Tantarelli was another very well-respected technician. So don't get me wrong when I assess and give you my opinions on this tweet here. I respect him. He does a lot of fantastic work. But when somebody says risk management is most important, it's kind of like an absolute. It's a colloquialism. It is something that has aged really well in the financial. When we talk about finances, we're always thinking risk. Most people immediately think risk. If I'm investing, what are my risks? That's like your number one question, right? Here's the thing you need to know. There's risk. It's intrinsic to the investing process. When somebody says risk management is most important, no, that's a given. Risk is a given. You can't manage risk if you don't take risk. There's nothing to manage. So when Larry Tantarelli offers something like this, and I tweeted back at him, when you offer risk management is most important, for clarity, you're referring to the exercise itself, which can span multiple disciplines that lend to the exercise. Right? I'm asking that. And the reason why I ask that is because that's everything we're doing here, right? I mean, we're looking at quantitative data, seasonal data, fundamental data, so that we have a good idea of what the probabilities are going forward. We're researching probabilities, which is a risk management technique of sorts. Think about the S&P 500 bull market duration table above. 60 months is the average bull market, right? And the market goes up over time. That's a given. One way or the other, the market is going to make higher highs over time. So why am I spending the most time on risk management? It doesn't make sense. I know the outcome. The outcome is a higher price for the S&P 500 if I'm an index ETF investor. Why is my greatest focus risk management? That doesn't make sense. What I should be looking for is how do I outperform the S&P 500? Is the offering from Larry Tantarelli focusing on the greatest probability? Right? The market is down. Going back to 1928, the market is only down about a quarter of the time. 75% of annual returns are positive. Only 25% of annual returns are negative. Why am I focusing so much on risk? That is not the greatest probability that the market's going to be down. He's focusing on one valuation event here. Risk management is most important. Cisco was the #1 stock in the NASDAQ in 2000. It still isn't back to 2000 level highs yet. 21 years is a long time to wait to break even. He's sensationalizing a very low probability. What is the probability that you're going to be invested in that one stock at the peak of its business model and the peak of its share price in a sea of the S&P 500 other 499 stocks? When I see a tweet like this, I'm like, son of a, he's emphasizing a point, focusing on literally the lowest probability. It always sounds smart when you're expressing risk management and prudence as it pertains to investing. But history suggests the order of magnitude for a focus of investing is misappropriated by the masses. And he reaches thousands of followers a day. The lowest probability is that the market will be down this year, next year. Over 4 years, the market may be down one of those years. Historically speaking, the market is down 25% of all years. It's up 75% of all years. Why are you so focused on risk? You're focused on risk because, again, we're talking about money matters. I love this. I extrapolated this from a book here. However, the vividness of the risk was such that it set off an availability cascade that made him risk averse. We are poor at dealing with rare events, right? Think about 1987. Think about October of 2008. Think about Volmageddon of 2018. We greatly overestimate their probability, and we are too heavily influenced by them in our decisions. Like, we know how bad if you live through those events, you remember, it's vivid in your mind how bad it was. The more vivid an event, the more prominent it is in our recall, and more probable we think that it is, when it's not. I just named 3 events since 1987. That was 33 plus years ago, 34 years ago. 3 events 34 years ago. They're not as probable as the severity of them, for their time, lends us to believe when we're thinking about risk. The greatest risk is that we're going to under-leverage our portfolios when the market is up the majority of the time because we're so focused on risk. And don't get me wrong, I'm not saying don't, just go all in, as they say, and the diamond hands and whatnot. I'm not saying that. I'm saying that if you're going to invest, know that risk is inherent. Spend the majority of your time focused on the probabilities, and that will automatically help you to define risk and limit risk in your portfolio. Speaking of folks that highlight risk to the market, Julian Biddle, with 42,000 Twitter followers, clearly disseminated this last year. This is from November 20th. The percent of MSCI world stocks beating the index year over year is up to 39%. The last 2 times we fell to 32% before working higher, 1999 and 2008. Like, what are you trying to do here, buddy? Scare the out of people? Of course he is. An extreme narrowing of breadth usually occurs around market tops. and current valuation, add current valuations to the mix. Again, remember, this is the date. Add current valuations to the mix, and things look a lot like the early 2000s. November 20th. Remember, in the month of November, we were up 11%. We still rallied into the end of the year. We're up another 20% since then. Social media, folks. Look smart. The chart is valid. It happened in the past. How many examples was he giving you? 2. A sample size of 2. That is not a study, folks. It's not. That's what people do in social media. And why do people keep investing in the stock market, even at these levels and these valuations, if you will? Well, the S&P 500 earnings yield versus the 10-year yield, look at the gap. You still have the S&P 500. You could get a 2.9% earnings yield versus the 10-year Treasury bond at 1.3%. Fix that and you might get your market correction. Until then, you need a catalyst. You need a catalyst. Everybody was a little panicked about the ADP private sector payroll report just yesterday and what that may mean for the non-farm payroll report, and is the economy weakening? You know, has the Delta variant produced greater, unwillingness to get back to work, if you will, because there's 10 million jobs available according to the JOLT survey. So I wouldn't panic. Even though CNBC went on their long-winded soliloquy of why this is so bad and, how does it manifest within the Fed's plans to announce tapering at some point. We just went through this in July with the July ADP report, folks. Right? Here's the tweet. A big miss on ADP. It was like less than half of what the expectation was. It came in at 330. They were expecting 690 for the month of July. And yet what happened when the non-farm payroll came out for the month of July that Friday? It was above estimates, and nearly, I think it was like around 900,000 jobs were created. So don't freak out. We literally just did this last month. Maybe this time the ADP will foreshadow a poor non-farm payroll report. Nobody knows. But history says the ADP report is not a strong reflection of what the non-farm payroll report will be. We'll see. We'll see tomorrow. There's no sense on worrying about it based on history. With that being said, September, we'll see how it goes. 7-month win streak for stocks. Has to end? Maybe, maybe not. But remember what happens by the end of the year based on the studies we talked about. Until next time, trade safe, everybody.